Inflation is at its highest level in 4 decades, and the Federal Reserve is set to raise interest rates starting in March. What does this mean, and how is it going to impact your personal finances? I'm Bradford with the Penny Pinch Guide to Personal Finance. First, make sure you hit that like button so we know and make more videos like it. Let's start out with the big picture. What is going on with inflation? It's no surprise to you or anybody else that the price of everything is going up. Whether you're paying for more per gallon at the pump or your grocery bill is larger, it doesn't matter where you're spending your money, prices are much larger now than they were a year ago. To put things in perspective, inflation right now, year on year, is just above 7%. We have not seen inflation this high since 1982. Well, it's no question to everybody that the cost of goods are going up significantly more than they used to. What causes inflation? At its simplest terms, when you're looking at an economy, inflation occurs when demand outstrips supply. Inflation is something that we've lived with for a long time, and we're actually pretty used to having an inflation rate of year on year of around 1 to 2%. And the whole reason that occurs is because as the population increases, whether from people being born or people immigrating to the country, we just have more people. And because we have that increased number of population, more people want to buy more things, which causes the price of things to go up slowly over time. The biggest reason we're seeing such a spike in inflation right now is due to the pandemic and how it completely disrupted supply chains. So while the amount of demand that we have has been relatively consistent with the slight increase as population has grown over the past 2 years, our supply has basically dropped through the floor because of the logistical issues, as we've seen on the news, with their significant amount of ships and harbors waiting to just bring their goods in. Because we have had such a decreased amount of supply and demand has remained consistent, the prices of everything have to go up. And because inflation is soaring, that is what's driving the Federal Reserve to have to raise interest rates. Now, at their meeting they had last week, they announced they're going to continue holding the Federal Reserve interest rate at 0% until March, at which point they're going to raise it multiple times throughout the rest of 2022. But why are they having to raise interest rates? How does that impact inflation? Because inflation is connected to supply and demand, when you have really low interest rates, that makes money cheaper to borrow. And when people are able to borrow more money, they're able to go out, they're able to buy a home with a lower mortgage, they're able to start a business, or for existing businesses, they're able to take out more debt to be able to expand. And when you have all of this expansion going on, there's a lot of people that want to use that money because it is so cheap to use. And that increases demand. And while we were in the middle of the pandemic and it had an artificial drawback of the economy because there were so many government lockdowns, demand had significantly dropped. And to incentivize more people to go out, take loans, and increase demand again to keep the economy moving, the Federal Reserve dropped their interest rate over and over again until it basically sat right around the 0% mark for the past 2 years. But now, because we're facing the issue of rapidly rising inflation, they need to figure out a way to bring that demand back down. And that's by making interest rates more expensive. By making interest and borrowing money more expensive overall, fewer people are going to be going out because there's going to be fewer opportunities that make sense to borrow money because it's just more expensive to use. Now, just raising interest rates isn't a one-size-fits-all solution because it comes with both its pros and its cons. Let's start out with the cons. The one that most people are going to identify readily is that as interest rates go up, if they're trying to get a mortgage or going out to acquire more debt through loans, it's going to be more expensive overall. And a side component of that is if you have any sort of adjustable loans, whether it's on a credit card, if you have an adjustable mortgage, as the interest rates go up, the interest rates on your debt is also going to increase if it is an adjustable loan. And another con that a lot of people aren't really familiar with is that as interest rates rise, unemployment also tends to rise at the same rate. Now, the reason for this interconnectedness is when money's cheap, businesses are able to expand. And as they expand, they have to hire more employees and more people are able to be hired, which lowers the unemployment rate. Now, the reverse is also true. When money becomes more expensive to borrow, businesses are likely to expand at a slower rate, meaning fewer new jobs. And as just time goes on, we have more people entering the workforce that aren't able to find jobs, unemployment has to rise. And this actually puts the Federal Reserve into a pickle as to what do they need to address because there are political drawbacks towards, one, having super high inflation. Nobody likes that. But at the same time, if you increase unemployment by making loans more expensive, that's also bad for the political party in charge. I'm not really going to dive into that, but it's just something to consider. Rising interest rates is not completely bad because there is the one pro, because as money becomes more expensive to borrow, that means your interest rates on your savings account, checking account, your certificates of deposit, they are all going to go up and you're going to make more money from those. Now, I think that pro is definitely outweighed by all the cons of increasing the interest rates, but it does mean that raising interest rates isn't completely bad. The better understanding of what's going on with both the inflation and the Fed increasing interest rates, how is that actually going to impact your finances? Let's talk about inflation first, because that's the easiest one to recognize, and at least for most people, it's going to be the most pressing, because as the cost of goods goes up, that's going to eat away at their monthly income. While you can't stop the prices of everything from going up over time, one thing you can do to lock yourself in at the current prices is to buy items that you know you're going to use in bulk. Whether that's non-perishable groceries, is it toothpaste, deodorant, things around the house like toilet paper that you know you're going to continue to use. If you can go to stores like Costco or Sam's Club, BJ's, and buy as many of those as you can within your budget, that's going to lock you in at a lower price over the long run as those prices continue to increase over time. And another component of battling against inflation is investing all of your money that is not your emergency fund, so it's actively working for you. One of the worst things that you can do is just leave your money sitting in a savings account, because while it's earning a pittance in interest, it is being eaten up by inflation. Well, no, your money is not actually going down in its numbers, it is losing its value, because what it can afford today is more than what it's going to be able to afford a year from now, because the cost of everything goes up. It doesn't mean you just go out and invest all your money right now. You need to research and understand what you're investing in, so that way you're comfortable with where your money's going. Whether that is in stocks, mutual funds, real estate, or crypto, understand what you're investing in before you put your money there. Now, when it comes to the Federal Reserve raising its interest rates, now there's a couple things you can do to put yourself in a better position moving forward. The first one deals with if you have any sort of adjustable loans, whether it's on your credit card, car payment, or mortgage. Keep this in mind. We're basically at the lowest we're ever really going to see interest rates. While it's possible for them to go a couple fractions of a point lower, there is a floor. They're not going to go below zero in terms of what you're paying, or else it doesn't make any sense to loan out money. But they could go up significantly. So to beat this, consider refinancing from your adjustable rate loan into a fixed rate loan. Even if it's a slightly higher interest rate, you know you're going to be locked in at that interest rate. And the Federal Reserve continues to ramp up their interest rate, you're going to be locked in, and you won't be at the whims of what the market does and what the Federal Reserve does later down the line. And a second note with dealing with the rising interest rates is interest rates are still really low. So if you're trying to figure out whether or not to buy a house or to continue renting, yes, while real estate has gone up considerably over the past 2 years, if you're able to find a home that is within your budget, I would highly recommend at least considering getting out a mortgage and buying that home and locking yourself in at the lower interest rates that are available right now. With everything becoming more expensive due to inflation and the interest rates going up because of the Federal Reserve, one thing you shouldn't have to worry about paying for is paying to file your taxes. Check out our video walkthrough right here, where I take you through how to use the IRS Free File program, where if you meet certain requirements, you can file your taxes completely free. I want to thank you for joining me today, and until next time, just remember to pinch a little.